Estate taxes, also known as the death tax, can significantly reduce the assets your heirs receive after you pass away. While not everyone is affected, thanks to federal exemption thresholds, individuals with sizable estates can face tax rates of up to 40% at the federal level, with additional taxes imposed in some states. Fortunately, with smart and proactive planning, it is possible to legally minimize estate taxes and ensure more of your hard-earned wealth goes to your loved ones. In this video, we explore the top 10 legal strategies to reduce estate taxes, ranging from basic to more advanced financial tools. These techniques not only help reduce taxable estate value but also offer benefits during your lifetime, like income reduction and asset protection. 1. Take full advantage of the estate tax exemption. The most fundamental way to reduce estate tax liability is by fully utilizing the federal estate tax exemption, which is over $13 million per individual as of 2025. Married couples can effectively double this exemption to $26 million through portability, allowing the surviving spouse to inherit the unused exemption of the deceased spouse. Keeping track of these exemption limits, which may change depending on legislation, is crucial for large estates. By staying under the exemption threshold through lifetime gifts and trust planning, you can eliminate or reduce estate taxes entirely. 2. Make use of the annual gift tax exclusion. One of the simplest and most effective estate reduction tools is the annual gift tax exclusion. In 2025, you can give up to $18,000 per person per year without affecting your lifetime exemption. For example, a couple with 3 children and 4 grandchildren can gift over $250,000 annually, tax-free. These gifts reduce the size of your taxable estate while transferring wealth efficiently. Regular gifting is especially powerful over time, and when paired with a long-term estate plan, it significantly reduces tax exposure. 3. Establish irrevocable trusts. Irrevocable trusts are a powerful estate planning tool because they remove assets from your taxable estate. Once assets are transferred into an irrevocable trust, you no longer own them and thus avoid estate tax liability on their future appreciation. Popular options include irrevocable life insurance trusts, ILITs, and grantor retained annuity trusts, GRATs. These allow you to pass on life insurance or appreciating assets without triggering estate taxes. Proper trust structuring is essential, and it's wise to work with an estate attorney to ensure compliance and effectiveness. 4. Use a family limited partnership, FLP. A family limited partnership can be a sophisticated and legal way to reduce estate taxes while maintaining some control over your assets. You can transfer assets, like real estate or businesses, into an FLP and gift limited partnership interests to family members at a discounted valuation due to lack of control and marketability. This strategy lowers the value of your estate for tax purposes while still enabling generational wealth transfer and potential income for your heirs. 5. Utilize charitable giving strategies. Charitable donations are not only altruistic but also strategically reduce your taxable estate. You can donate directly to charities, set up charitable remainder trusts, CRTs, or create a donor-advised fund, DOF. A CRT allows you to receive income for life, or a fixed term, after which the remainder goes to charity, removing the donated asset from your estate and providing tax deductions. These vehicles not only reduce estate taxes but also offer income tax and capital gains advantages during your lifetime. 6. Transfer assets during your lifetime. Waiting until death to transfer assets means they may be taxed at full estate tax rates. Instead, consider lifetime asset transfers, especially of appreciating assets. By giving assets while they're still lower in value, you move future appreciation out of your estate. This is especially useful for business owners, art collectors, or real estate investors. Combining lifetime transfers with annual exclusions, valuation discounts, and trusts allows for an effective, layered estate reduction strategy. 7. Purchase life insurance through an ILIT. Purchasing life insurance through an irrevocable life insurance trust, ILIT, ensures the policy's death benefit is not counted in your taxable estate. The trust owns the policy, pays the premiums, often funded via gift exclusions, and distributes proceeds to beneficiaries tax-free upon death. This strategy can be used not only to provide liquidity for paying estate taxes but also to preserve wealth outside of your estate's taxable reach. It's a cornerstone technique in high net worth estate planning. 8. Set up a qualified personal residence trust, QPRT. A qualified personal residence trust, QPRT, allows you to transfer your home or vacation property to beneficiaries at a reduced value while retaining the right to live in it for a set period. After the term ends, ownership transfers to your heirs, and the home's value, along with future appreciation, is removed from your estate. The value of the taxable gift is discounted based on current interest rates and the duration of the trust. This is a highly effective method for wealthy individuals with valuable residences. 9. Consider state estate taxes and domicile planning. Several U.S. states impose their own estate or inheritance taxes with much lower exemption limits than the federal government. By changing your legal domicile to a state with no estate tax, like Florida, Texas, or Nevada, you may significantly reduce or avoid state-level estate taxes. This can involve spending a majority of the year in the new state, establishing residency, and severing tax ties to the original state. If done properly and documented thoroughly, this can yield substantial estate tax savings. 10. Implement a dynasty trust or generation-skipping trust. Dynasty trusts and generation-skipping trusts allow you to transfer wealth to grandchildren or great-grandchildren while avoiding multiple layers of estate tax. These trusts take advantage of the generation-skipping transfer tax (GST) exemption, which mirrors the estate tax exemption. Once assets are placed in such a trust, they can grow and be distributed across generations without further estate tax assessments, creating a tax-efficient legacy that can last for decades. It's a long-term strategy requiring careful planning but offers massive multi-generational tax savings. Reducing estate taxes requires more than just writing a will. It demands a thoughtful, proactive approach that leverages the full range of legal strategies available. From using exemptions and gifting to setting up irrevocable trusts and charitable vehicles, there are multiple ways to minimize the impact of estate taxes on your legacy. The earlier you start planning, the more opportunities you have to reduce your taxable estate and protect your heirs. Consulting with qualified estate planners, tax attorneys, and financial advisors is critical to ensure your estate plan is compliant, effective, and aligned with your values and goals. By employing these top 10 estate tax reduction strategies, you can preserve your wealth, support your loved ones, and leave a legacy that reflects your life's work.